Most people think life insurance only pays out when you die. But what if you get sick and you can't work? For how long can your family survive financially without your income if you can't work? What happens then? What if I told you that life insurance today could actually pay you while you are alive? And it's true. Life insurance has evolved over the years. It's no longer just the old kind of insurance that only pays out when you die. There is also the new kind of life insurance that includes living benefits, which means if you're to get diagnosed with anything and it's considered chronic, critical, or terminal, and you're basically down for 90 days or longer to recover, you have the ability to accelerate a portion of that death benefit to yourself to basically pay you while you are alive to cover any medical expenses or just normal living expenses. Here is a list of some of the reasons and some of the ways you might use that extra money that's coming in to support you financially. Suffering a critical or chronic condition no longer means death. An unexpected illness or injury could have a drastic effect on your financial future. Typically, two things are going to happen. Your expenses are going to go up due to unexpected medical costs, and your income is going to go down due to the inability to work. And when your expenses get higher than your income, that is when debt piles up. Now you might be wondering, what is a critical or chronic medical condition? Here is a list of some severe medical conditions that qualify under a critical illness. To highlight some of these conditions, according to the American Cancer Society, a little over 2 million new cases of cancer were reported in the United States in 2024, with 611,000 deaths. And according to the CDC, heart disease is the leading cause of death among men, women, and people of most racial and ethnic groups. This chart shows the heart disease rate by county in the United States, and the dark red isn't good. And in the US, someone has a heart attack every 40 seconds, meaning every year, 805,000 people in the US will have a heart attack. So as you can see, these conditions are more common than you might realize. But living benefits includes chronic conditions as well. Chronic conditions means that someone is unable to perform 2 of the 6 activities of daily living on their own for a consecutive 90 days, or they have the presence of a severe cognitive impairment. Typically, these conditions will result in the individual needing some kind of long-term care. According to ASPE, 70% of adults that survive until age 65 develop the need for some kind of long-term care. Now, what if your condition is so severe that you're given a terminal diagnosis? Living Benefits steps in if you're diagnosed with anything and you're given 12 months or less to live. Some carriers actually branch out all the way up to 24 months or less to live. Now, I'm a big believer that owning some kind of life insurance is better than no life insurance. But if you own the old kind of life insurance and you're diagnosed with something that's critical, chronic, or terminal, you don't have any options. For example, I met a young gentleman in his mid-30s about 3 years ago who was formerly an airplane mechanic, and he suffered a really bad back injury on the job that basically left him immobile for years, and he was never able to return back to work. He is a former veteran, and he tried like everything possible to get access to disability benefits, and it took him 2 years to be able to see some kind of income start to come in. And I asked him, what did he do to survive financially during those 2 years while he was waiting for disability? And he said he drained everything. He went through every bank account. He went through every retirement account. He even had to drain his kids' college funds to survive so they didn't lose the house. And when I told him about living benefits, he started to cry. And he looked at me and he said, "Where were you 3 years ago?" Now I can even share my own personal story. 15 years ago, I had a normal family. My mom, my dad, my brother and I, all healthy. Everything was great. And one morning, my dad had a stroke that landed him in the hospital. And not even 2 weeks later, he got diagnosed with stage 4 cancer and was given 3 months or less to live. He never again returned to work, and he did end up passing away after about 2.5 months. Living benefits wasn't around back then. Luckily, he had enough life insurance to cover the cost of our house, so we didn't end up homeless when he died. But to think that if that same story happened to a family today, there could be a product that they could pull money out of to pay their medical costs and allow them to live comfortably while someone is trying to recover, there's so much power in that. Having access to living benefits really can save your family financially. Now, you might be wondering, well, how does it actually work? So it's completely dependent on the severity of the condition. The more severe the medical condition you have, the higher the payout the insurance company is going to offer you from your life insurance policy. And nowadays, living benefits is pretty much standard with most term insurance and permanent life insurance. Now, most people think that this product would be outrageously expensive. But if you take a look here, you'll notice if you put living benefits inside of term life insurance, it's actually quite affordable. And term life insurance is really meant to cover you during the most vulnerable years of your life, which is your 30s, your 40s, and your 50s, while you're carrying the most debt and you have a young family that is dependent on your income. And you'll see here that it can be really affordable. It can boil down to just a couple dollars a day to be able to have access to living benefits, meaning you can accelerate that death benefit if you get severely sick or injured. Now, the cost is going to vary. It's going to be based on the individual's age, health history, and criminal background. But if you can get approved, honestly, in my opinion, they're fantastic, and I do truly believe they're something everybody should consider owning. Now, you might be left there thinking, this just sounds too good to be true. How can the life insurance companies possibly afford to do this? It's not too good to be true because they have a formula to calculate all of this out. If you own a 30-year term insurance policy for $500,000, friends, they're not going to cut you a check for $500,000 if you have a qualifying condition. They're going to see what that $500,000 would be worth at today's rates based on how many years until that term insurance expires. So they'll pay you a percentage of that. But still, compared to the alternative in the stories that I shared with you earlier, it's a minor cost to pay to have financial peace of mind for your family. Now that you have all of the details on how this product works, if it's something that you're interested in, you've got to see if you can get approved. The insurance companies are going to look into your age, your health history, and your criminal background, and that's going to determine the cost of the product and whether or not you can actually get approved to own it. Unfortunately, if you currently have a critical, chronic, or terminal medical condition, you're most likely not going to be able to get approved for living benefits. This is why it's so important to get these products in place as young and healthy as possible. Now, if you own life insurance and it's the old kind and it only pays out when you die, in my opinion, you've got the wrong product. You need to sit down and see if it's able to be upgraded. If you'd like to talk to me and my team, you can click the link in my bio or in the description below to get access to our calendar for a free quote. Until then, I'll see you next week on YouTube.